Welcome to IFRS Talks, your source for all things IFRS. I'm your host, Laura Kennedy, and today we're joined by Karsten Ganssauge to get the highlights from the June IFRS Interpretations Committee meeting. Hi Karsten, welcome back to IFRS Talks.
Glad to be back, Laura.
Today you're going to give us an overview of your most recent IFRS Interpretation Committee meeting. You guys met on the 11th of June and there were a few things on the agenda for us to chat through. So I can see, and I probably predict this is one of the biggest topics, something came back that we discussed previously. So on reportable segments, there was a question and comment letters to discuss. You also had a new submission to do with IS7 cash flow statement. And then the staff came to talk to you about some of the ISB's projects as well, the business combination project that's going on right now and the intangible project. So a few things to touch on. Why don't we start with the question that came back on reportable segments? So it was actually all the way back in December that we last discussed this on the podcast, Karsten. So maybe can I ask you to provide us a brief reminder of what the issue was?
Sure. So there were actually two main aspects to the question raised by the submitter. So the first part of the submission relates to some details around the requirements in paragraph 23 of IFRS 8 to disclose specified amounts included in the segment profit or loss reviewed by the chief operating decision maker. And the second part of the submission relates to the meaning of material items of income and expense in the context of paragraph 97 of IS1 as referenced in paragraph 23F of IFRS 8. So in simple words, in essence, what this refers to is the requirement in IFRS 8 to disaggregate material items of income and expense for the purposes of segment reporting. Now, for this purpose, IFRS 8 refers to the related guidance in paragraph 97 of IS1, which is further specified in paragraph 98 of IS1. Now, that's quite a bit of detail, but the question really was what exactly those material items of income and expenses are that need to be disaggregated in an entity segment reporting.
Thanks, Karsten. And I remember last time it did cause quite a lot of discussion around what material items are. So I guess, did that come through in the comment letters? Can you share with us the type of feedback the committee received and then what outcome has that led to in terms of an agenda decision?
Yeah, that's right. So the first part of the question was actually quite straightforward and uncontroversial. So let's focus on that second part of the submission around the meaning of material items of income and expense.
Okay.
So the committee received 27 comment letters on this matter, which is quite a lot. So whilst there were almost no concerns on the first part, the second part of the submission was quite controversial, and the majority of respondents actually disagreed with that part of the tentative agenda decision, or TAD. So let me remind folks in a bit more detail what the issue is and why it's such a controversial topic. So in simple words, IFRS 8 requires, amongst other things, disaggregation of material item of income and expense, as described in paragraph 97 of IS1. And as the paragraph 98, which I mentioned earlier, provides some examples of such items that require separate disclosure, which include, for example, write-downs of inventories or PP&E. So IFRS 8 requires disaggregation of such items by segment. However, the items listed in that paragraph 98 are not an exhaustive list. So the question essentially was, what other items of income or expense need to be disaggregated in the notes by segment? So to explain the issue, let me maybe describe the two extreme positions on each end of the spectrum. So on the one end of the spectrum, some people have suggested that only disaggregation of non-recurring, one-off or unusual items is covered by that. On the other end of the spectrum, some people have suggested that because the items listed in paragraph 98 are only examples, that anything that is material needs to be disaggregated by segment. So on that end of the spectrum, on the extreme, some supporters of this view are suggesting that this essentially means that every line item presented in the statement of profit or loss that is material needs to be disaggregated by segment. So some go even further and suggest that any further disaggregation of P&L items provided in the notes also needs to be considered in terms of whether that might need to be disaggregated by segment as well, if that information is material. So this view would essentially mean that a complete P&L needs to be presented for each reportable segment, and potentially even more detailed disclosure if more disaggregation of items of profit or loss is provided in the notes. Now, I think the committee's discussion suggests that neither of these extremes views are appropriate. More specifically, the committee observed that in applying paragraph 23 of IFRS 8, by disclosing for each reportable segment material items of income and expense presented or disclosed in accordance with paragraph 97 of IS1, an entity first assesses whether information about an item of income and expense is material in the context of its financial statements taken as a whole, then considers how to aggregate information in the financial statements, then considers also the nature or magnitude of information, or in other words, qualitative or quantitative factors, or both, in assessing whether information about an item of income and expense is material, and considers circumstances including, but not limited to, those in paragraph 98 of IS1. So clarifies that the items listed in paragraph 98 of IS1 are not an exhaustive list. And finally, the committee decided to add a sentence to the agenda decision, observing that paragraph 23F of IFRS 8 does not require an entity to disclose by reportable segment each item of income and expense presented in its statement of profit or loss, or disclosed in the notes. So in determining its disclosures of information by reportable segment, an entity applies judgment and considers the core principle of IFRS 8, which requires an entity to disclose information to enable users of its financial statements to evaluate the nature and financial effect of the business activities in which it engages and the economic environment in which it operates. So essentially, this means that neither of the two extreme views that I mentioned earlier are appropriate, and that judgment is required based on an entity's individual facts and circumstances to determine the appropriate level of disaggregation by segment. Now, whilst this provides some steer to entities, my personal view is that I think the committee could have been more clear in the agenda decision. However, the majority of committee members felt that we could not go further without adding to the requirements of IFRS accounting standards. So I think that the entities are going to have to think about what exactly the agenda decision means for them based on their individual facts and circumstances. I think it's important to note that the agenda decision is clear that a complete disaggregation of P&L items by segment is not required. However, I think the agenda decision still leaves quite a bit of room for judgment. I certainly expect that this might trigger some interesting discussions. As always, the agenda decision is subject to non-objection from the board. I suspect this will go to the board at their July meeting, so watch this space on this matter.
Thanks, Karsten. Sounds like a really interesting topic. It's always difficult considering what is material information. And then I guess the other thing maybe to note there, when the agenda decision is finalised, assuming non-objection, I think the usual wording for implementing any changes that might come out of an agenda decision is to do with having sufficient time to work through that. So I think that's very relevant here too. Okay then, so I mentioned before there was another item on the agenda. So this was a new submission coming through to the Interpretation Committee, and that was to do with IS7, so cash flow statement. And I can see here, Karsten, it was to do with cash flows that are related to variation margin calls. So can you share with us a bit about that item?
Sure. So this is essentially a submission asking about the classification of cash flows in the statement of cash flows for a particular type of contract. On a high level, the fact pattern relates to a contract to buy or sell commodities at a predetermined price at a specified future date. So a derivative contract. Now, that derivative contract is essentially cleared and collateralized to market, which means that during the life of the contract, the counterparties make or receive daily payments based on the fluctuations of the fair value of the contract, which is called variation margin call payments. Now, the question essentially was how those daily payments that are made to adjust the cash collateral that is to be provided based on changes in the fair value of the underlying derivative contract should be classified in the statement of cash flows. So essentially the question was whether these cash flows should be classified as cash flows from operating activities or as cash flows from activities other than operating. Now, the fact pattern was not very detailed and just said that there may be various reasons for entering into these types of contracts. Now, Respondents' feedback indicated that cash flows related to variation margin payments might be classified differently between different entities because of differences in the underlying contractual terms, the contract duration, the purposes for which entities are using the contracts, as well as differences in the business activities of the entities. So, if there are differences in how cash flows are classified in the cash flow statement because of such reasons, it appears that those differences do not necessarily indicate diversity in the application of the relevant IFRS requirements. And finally, outreach also indicated that some of the world's largest central counterparties had amended their rules such that variation margin payments are now legally considered settlement payments rather than transfers of collaterals. So because of this, the committee tentatively decided that outreach did not indicate that the matter has widespread effect, and therefore tentatively decided not to add a standard setting project to the work plan. I actually think there are quite a few issues with IS7 and cash flow presentation. Certainly, at least in my view, that is a very important topic. So I believe that looking into cash flow presentation, providing more guidance on cash flow presentation is an important topic that I would view as a high priority topic for the board. And as many will be aware, cash flow presentation is on the board's pipeline of projects. However, even though cash flow presentation overall clearly is an important topic and more guidance in this area would be helpful, my sense is that the particular issue described in the submission does not have widespread effect. Therefore, I do support the committee's tentative decision not to add a standard setting project to the work plan for this particular matter. But that's, of course, a tentative view. So let's see what the comment letters say on this one. And we will, of course, revisit the matter based on the feedback from comment letters.
Thanks, Karsten. That makes sense. And I'm sure the ISB's project on cash flows will be highly anticipated by many people. So that leaves us to the last couple of things that you had on your agenda for the committee. And I can see that those were both updates on two exciting ISB projects. So one was the intangible assets project that they're kicking off, and the other was on the business combination exposure draft, which we had Craig from the ISB come along and chat on the podcast in April. So if you could share with us, Karsten, what was discussed at the committee?
Sure. So both the intangible asset project and the business combination disclosures, goodwill and impairment, or BCDGI project, are important projects. Now, at the June IFRIC meeting, we spent around 4 hours just discussing the proposals on the BCDGI project and the overall approach for the intangible asset project. So let's maybe start with BCDGI. So just as a reminder, this exposure draft has the objective to improve information that entities provide about their business combinations. The exposure draft, or ED, essentially contains a package of proposed improved disclosure requirements on business combinations, as well as a few targeted changes to the impairment test of cash-generating units containing goodwill. So, in relation to business combinations, the ED aims to improve information for investors about the performance of acquisitions. In order to achieve these objectives, the ED proposes changes to IFRS that would require disclosure of information used by key management about the performance of strategic business combinations, as well as a number of other disclosures, including disclosures of quantitative information about synergies that are expected from a business combination. The other area addressed by the ED relates to concerns around impairment losses on goodwill, sometimes being recognized too late, and also seeks to simplify the impairment test. So the other project that the committee provided input on was the ISB's research project on intangible assets, which has just started and is still at a very early stage. So the purpose of this session was essentially to get committee members' input in terms of defining the problem the ISB is trying to solve, the scope of the project, and how best to stage work to deliver timely improvements. The questions raised to committee members also included a discussion around which topics should be the highest priority and whether there's anything missing or anything that should be excluded from the project. And finally, committee members were asked on their views on possible project approaches and on which project approach would likely best respond to stakeholders' concerns and allow timely progress. So I think IS 38 does work reasonably well, but it is quite an old standard that is not necessarily fit for purpose, considering how business models have evolved over the past decades. So I certainly think the intangible asset standard needs to be revised and updated to address, for example, new types of intangibles, such as cryptocurrencies, as well as new ways of accessing intangibles, such as, for example, software as a service or SaaS arrangements. I also think that there are many other application issues where some further guidance would be really helpful. In my view, some examples of practice issues that have been out there for a long time include, for example, how to determine the costs of an intangible, for example, in relation to variable payments made for the acquisition of an intangible. Questions around the unit of account, both for the buyer and for the seller. So, for example, when to think about partial derecognition for intangibles, and how to account for long-term non-cancelable contracts that grant rights in relation to an intangible, and whether these should be accounted for as intangibles versus as executory contracts. Overall, many committee members felt that a so-called all-in-one approach that would seek to address all topics identified by stakeholders might be the best approach from a conceptual perspective, but many also felt that there was a significant risk that such a project would not be feasible to do in a reasonable period of time. And so my sense was that many committee members were more supportive of what was called an early evaluation project approach, which would essentially prioritize topics and only further explore selected topics that meet a specified threshold in order to achieve improvements to these high priority topics on a timelier basis. Now, both on the BCDGI and also on the intangibles projects, I think we had a really good and lively debate at the committee. So if you're interested in more details, I recommend to listen into the committee's discussion, which as always, are available on the ISB website.
Thanks, Karsten. That was a great overview. Sounds like 4 hours was a lot of discussion. I'm not surprised because they are two very interesting topics, and we'll certainly have more podcasts, I'm sure, on both of those topics later down the line. Okay, so that was everything that you had on the agenda for this month. So that just leaves me to say, Karsten, thank you as always for keeping us up to date with the committee and sharing your insights. And we will see you again, I believe, in September is the next meeting.
That's right. Thank you very much.
Great. Okay. And thank you to our listeners. To never miss an episode again, remember to subscribe wherever you get your podcasts. And until next time, happy accounting.
This podcast has been brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitution for consultation with professional advisors.